Hey, how's it going? USFC Saxoki here. Smarter, simpler, more money. Currently, me and my wife are in the process of buying a home, and buying a home greatly increases your wealth. I'm going to show you how using the basic accounting equation. Now, this is so basic, and I'm not an accountant, I'm not a CPA, but I just know a little bit about it, and it's kind of interesting how it affects your personal financial numbers. So without further ado, let's get started. Okay, so this is your basic accounting equation, all right? So alcohol equals love plus enjoyment, all right? That's your basic accounting equation. Just kidding, it's assets equals liabilities plus equity. Just like any other math equation, this has to balance out. So this side has to equal this side at all times. So what I'm gonna do is look at my current situation, or our current financial situation right now, and what it's gonna look like after we purchase this house, essentially. Real quick, so again, assets. So before house, all right, so I have a little more than this, but I have about $80,000 saved in cash in a liquid, it's in a money market account actually. So that's my asset, all right. Liabilities right now, me and my wife have nothing. We have no consumer debt, we have no credit card debt, we have no car loan, so liabilities are zero, we have zero. And then, so this equation has to balance. So equity, I have $80,000 worth of cash in equity, essentially. So let's go over this real quick. Why alcohol equals love plus enjoyment. All right, so, So essentially, look at this bottom line here. So before house, after house, went from $80,000 in assets to $340,400 in assets. Huge jump there. Using the power of leverage, that's the mortgage. And we actually increased our equity by $2,000 because we paid essentially $2,000 under what the house is worth. So let's break this down further. So the house is worth $325,000 based on the appraisal. You take that $80,000 minus the down payment of $64,600. That's 20% of $323,000. Leaves you with that much cash. So after it's all, the dust is settled, I'll have roughly that much. Yeah, their closing costs. The seller is paying most of the closing costs. Just really simple example. Have that much left in my savings account and still have a job, still have income, which we will forever. That equals $340,400. The mortgage, this was $323,000 minus the down payment. That's how much we're gonna owe over 30 years. My plan is to make a $2,000 a month extra principal payment while I can. So hopefully we'll have that paid off in 10 years or less and pay much less in interest. And then over here we have our equity, so the down payment. So essentially, I'm not spending $64,600. I'm trading one asset for another. So equity in the home, that's ours. The cash, the increased value of the home equals $82,000. That plus that equals that. That's your accounting equation. So I went from $80,000 that much, increased my equity by $2,000, and increased my liabilities by a bunch. That's the basic accounting equation. That's how buying assets essentially makes you richer. Now here's the scary part of buying a house if you don't know, okay? So our interest rate's a little over 3%. I'm fine with that, that's great. If we just made the monthly payment that we're gonna have to make over 30 years, yes, we got a 30-year mortgage, I'm gonna pay extra on it, whatever. Over 30 years, we would pay, I think it's like $170-some thousand in interest alone. So yeah, that's a huge issue. So right now with this income that I have, I'm planning on making a $2,000 a month extra payment on top of the regular payment. So $2,000 a month principal payment. And if I could do that indefinitely, we would have it paid off in about 7 years. I'm hoping to keep it at 15 years or less, but we'll see. This really pissed me off about a month ago. So originally I tried to finance through Navy Federal. It's the credit union that I go through. I just want to keep everything in one place. You know, I could see my balances every day when I log on to my banking information. And we got pre-approved through them, but as the process went forward, I had this one really bad phone call with them, and essentially the lady was like freaking out on the other end, even though she had no stake in this. I'm just trying to get a loan for this. So what pisses me off about this, and it's kind of the whole problem with the whole system, in my opinion, with like credit and things, is that we have no debt, no consumer debt, no car loans, no personal loans, nothing. You can tell by our bank accounts that we are, what do they call it? Good savers, extremely good savers. We save money. So no debt, tons of savings, decent, good size income, great credit scores. My wife's credit score is, when you do a loan, they run all three of your credit reports from the three companies. Don't know what I forget what they're called. Great credit score. I think my wife's is over 800. Mine was like 777. Great credit score. Over 2 years of job history. Currently employed, and because I'm in the military and my LES, it's not indefinite. Like, they were having issues with like verifying employment for some reason. Like, oh, you can't prove employment. Like, what are you talking about? I've been in the military for over 8 years. Like, I could get hurt and get forced out next week. Point is, who are these people that lenders know have a job for the next 30 years, a good job? Like, who are these people? I want to know. I want to know who has a good job lined up for 30 years into the future. Like, it just really made me mad. It's like, how amazing do you have to be to have no issues with getting a home mortgage to buy a home in the United States of America? It's like, are you kidding me? I have a bachelor's degree. My wife has her master's. Like, we can afford an $1,100 a month housing payment. We're gonna find a way. Like, are you kidding me? Oh, it really made me mad, and I ended up not going with them because of it. I'm like, nope, I don't want to deal with you anymore. Went to a more local lender and got lending that way. But it just put a really bad taste in my mouth, and it really scared me. It's like, holy cow, what kind of job, what kind of credit do I have to have? How much savings do I have to have before you're like, yeah, you're good to go? Like, what kind of system is this? Another thing about credit, so we have these great credit scores, and then she was saying, essentially, you don't have very long history of credit, and because you don't have revolving balances, meaning we don't pay interest because we're not stupid. It shows kind of a riskiness to the lender, and just like, so to do it right in America, you have to, 1, always be in debt, 2, always be paying a ton of interest on that debt, and 3, make the minimum payments, which is so stupid because you're paying a ridiculously high interest rate for credit cards, at least probably 8 to 20%. Stupid, right? I've had my credit card for almost 4 years now, and I have paid 0 in interest. 0. Nothing. I've never paid any interest. I use it all the time. I get a little money back. I use it for normal purchases, and I always just pay the balance off. So it's like, okay, so if our credit was bad, wouldn't our credit scores reflect that? It's like they had no correlation. How you use credit and your credit score didn't match up. It was like, what are you talking about? Holy cow. So that really made me mad too. It's like, if we had bad credit, we would have bad credit scores, right? So essentially, you always have to be in debt over a car. You need to have a mortgage. You need to have credit card debt in order to look like a safe borrower to a lending institution. What is that? Why can't you just like save your money, pay all your bills on time, never have any debt? Doesn't that look good? Like, it's just one of those things that just really makes me kind of, it's a broken system, and it's why so many people are in so much credit card debt, because first of all, they're just dumb about it. Like, they use credit cards as an ATM. But second of all, it's like we're kind of duped into this thing that we have to have debt to establish credit, so that we can buy more things. What's good about buying a house too is that mortgage payment will essentially show the whatever lenders that we're good if we ever want to borrow money for something, which I really don't want to have to do again. Okay, enough ranting. There it is again. Right, see those kids out there in the reflection. There it is again. Basic accounting equation. We went from $80,000 to $340,000 using leverage. That's the basic lesson. All right. Smarter, simpler, more money. See you next time. So a lot of questions you might have is why did we put 20% down? Why didn't I do a VA loan? I could have done that, not put anything down. Well, the 20% rule is this is how I think it's a good rule to follow. It shows the lender that you have stake in the place. You're going to pay thousands of dollars less in interest. Your monthly payment is going to be much lower than if you don't put anything down, and you already have equity in the home. So let's say in 2 years, I'm not planning on doing this, but in 2 years you have to sell for whatever reason. Hopefully the value of the property is gone up. You can get out of there breaking even or even making some money at least. Oh, and the other benefit of putting 20% down is that you don't have private mortgage insurance, which is basically the lender's saying if you don't put 20% down, the lender's like, well, you're a little bit risky, so in case you default on this, we're gonna have you pay basically insurance for them, extra payments for them because you're more risky. So it makes the process easier, and it's just kind of I would have put more down if I had to. I could put another $10,000, $20,000, $30,000 down, but I'd rather not.